Imagine it's 1927. You're a young accountant living outside Detroit, Michigan. Your salary is respectable, and every morning you walk past houses with polished automobiles parked outside. Some belong to men who earn more than you. Others belong to men whose salaries are almost identical to yours. Then one of your coworkers arrives in a new car. You know what he earns, and that is what makes the car interesting. A few years earlier, owning something like it would have required years of saving. But America is changing. Manufacturers are producing goods faster. Then households can accumulate the cash to buy them, and finance companies have discovered a solution. You do not need to possess the money today. You only need to afford the monthly payment. So you sign the papers. The automobile appears immediately, while the financial cost disappears into a series of future payments. Almost a century later, that mechanism has become so normal that most people barely notice what it does. The status trap is usually described as irresponsible spending. Someone earns money, buys expensive clothes, drives a car they cannot really afford, takes expensive vacations, and eventually wonders why their bank account remains empty. But that explanation misses the deeper system. The real mechanism is the conversion of private financial capacity into public evidence of success. A person can look wealthy while accumulating very little wealth. Another person can accumulate substantial wealth while displaying almost none of it. The difference is not necessarily income. It is what happens to income after it arrives. This pattern has been documented for more than a century. In 1899, economist Thorstein Veblen published The Theory of the Leisure Class and described what became known as conspicuous consumption. His argument challenged the assumption that people buy things only because those things are useful. Sometimes people also buy them because other people can see them. The visibility becomes part of the product. A watch tells time, but a luxury watch can also communicate position. A car provides transportation, but a particular car communicates something about the person driving it. A house provides shelter, but its location, size, and architecture can become a public statement about where its owner stands. Once consumption becomes communication, the economics change. You are no longer comparing only the usefulness of an object with its price. You are also comparing the social message of the object with its price. Veblen was observing America's Gilded Age when industrial fortunes had created an extraordinarily visible wealthy class. The rich demonstrated position through houses, clothing, servants, and leisure, but the important mechanism was what everyone below them learned from watching. Status standards travel downward. The group immediately above you becomes a reference point for what success is supposed to look like. The next group imitates that group, and another group imitates them. People do not need to possess the wealth of the class above them. They only need access to enough visible symbols to resemble it. During the 20th century, another system made that imitation dramatically easier: consumer credit. Debt itself is ancient, and installment selling existed before the 20th century, but mass production created a new economic problem. Factories could manufacture automobiles, refrigerators, washing machines, and other durable goods faster than households could accumulate enough cash to purchase them. The constraint was no longer production. It was consumer liquidity. Credit weakened that constraint. General Motors Acceptance Corporation was established in 1919 as automobile financing expanded. Instead of waiting until households accumulated the full purchase price, financing allowed consumers to obtain the product immediately and distribute the cost across future income. That changed the fundamental question. Instead of asking whether someone could afford the full purchase, the consumer increasingly had another question available: can I afford the payment? The distinction sounds small, but mathematically it is enormous. The first question compares a purchase with accumulated capital. The second compares a purchase with future cash flow. Once expensive goods could be purchased from future income, visible consumption was no longer limited by current wealth. Appearance could move ahead of the balance sheet, and debt could fill the distance between them. This is where the status trap becomes structural. Imagine two households earning $100,000 a year. The first increases visible consumption whenever income increases. A better car, a more expensive neighborhood, upgraded furniture, more expensive travel, and better restaurants. Nothing appears individually catastrophic, which is precisely why the mechanism works. The status trap rarely arrives as one enormous mistake. It arrives as a sequence of reasonable upgrades. The second household earns the same amount but allows its visible lifestyle to rise more slowly. At first, the difference may seem insignificant. One household simply appears more successful. Underneath, however, their financial structures are moving in different directions. The first converts more income into consumption, while the second retains more income as capital. Capital can remain productive. Consumption usually cannot. The car depreciates. Clothing ages. The vacation ends. The restaurant bill disappears. Yet every dollar used for those things came from the same pool of income that could have strengthened the household balance sheet. That is the hidden mechanism. The status trap is not only the cost of what you buy. It is the capital that never gets created because you bought it. And missing capital has a future. Money retained today can remain productive tomorrow. And any returns it generates can themselves remain productive. The opportunity cost therefore grows with time. Status consumption often works in the opposite direction because many visible status goods require replacement. The car that once produced admiration eventually becomes an old car. The phone becomes last year's model. Fashion changes, neighborhood standards rise, co-workers receive promotions, the reference point moves. A perfectly functional vehicle can lose status value long before it loses transportation value. A perfectly functional phone can lose signaling value while performing almost exactly the same functions. The product has not failed, the comparison has changed. Modern research has demonstrated this mechanism experimentally. Studies examining inequality, borrowing, and conspicuous consumption have found that consumption can increase when purchases are observable and capable of signaling status. Costly borrowing can also increase under those conditions, particularly among people with fewer financial resources. Visibility changes behavior. Credit magnifies the effect. Inequality supplies the comparison. Put those forces together, and a feedback loop appears. A person sees a higher consumption standard and feels pressure to approach it. Credit makes approaching it immediately possible, but the resulting debt reduces future financial capacity. The person can become financially weaker while appearing economically stronger. That is the trap. Also explains something that otherwise seems contradictory. How can a society become visibly richer while many households remain financially fragile? Because visible consumption and net worth measure different things. Walk through a prosperous suburb and you can see cars, houses, landscaping, and clothing. You cannot see loan balances, retirement accounts, emergency savings, or whether the vehicle outside the house is fully owned. You cannot see whether the household could survive 6 months without income. You cannot see the interest rate or the credit card statement. Wealth is largely invisible. Consumption is designed to be visible, so people naturally compare their private financial reality with other people's public consumption. And that comparison is structurally distorted. You see the vacation, not how it was paid for. You see the renovated kitchen, not the home equity balance. You see the vehicle, not years of payments. You see the restaurant, not the retirement contribution that did not happen. Well, the visible evidence is real, but it proves only that someone is consuming. It does not prove that they are wealthy. The expansion of consumer credit made that distinction increasingly important. Credit brought enormous practical benefits because households could smooth expenses and finance durable goods without waiting years to accumulate cash. But every financial tool also changes incentives. Credit separates the moment of consumption from the moment of sacrifice. The benefit is immediate. The financial consequence is delayed. That separation becomes especially powerful when the purchase is connected to status because the social signal arrives today while future income absorbs the cost. This is where monthly payment thinking becomes important. A $50,000 vehicle sounds expensive. A monthly payment sounds manageable. A $10,000 purchase sounds significant, while a sequence of smaller payments can sound ordinary. Financing does not necessarily make the object cheaper. It changes the psychological unit being evaluated. Instead of evaluating total capital committed, the buyer evaluates whether the payment fits inside this month's income. Once households organize their lives around payments, income can rise without financial freedom rising with it. A raise creates room for another payment. A promotion creates room for a larger mortgage. A bonus creates room for another down payment. The household earns more, but the surplus is quickly claimed by a higher consumption standard. This is lifestyle inflation, and its most effective feature is that it often feels exactly like progress. The person earning $60,000 wants the lifestyle associated with $80,000. At $80,000, the reference point moves toward $120,000. At $120,000, the neighborhood changes, coworkers change, restaurants change, vacations change, and cars change. The comparison group moves upward with the income. This is why status competition has no natural finishing line. There is always another neighborhood, another vehicle, another hotel, another brand, and another person whose visible life can reset your definition of normal. The mechanism becomes even stronger when technology expands the comparison group. Historically, geography limited exposure. A factory worker in 1925 might see the wealthiest family in town. A middle-class professional in 1960 might compare himself with neighbors, coworkers, and people on television. The modern consumer carries a global status hierarchy in a pocket. A young employee can spend breakfast watching the vacation of a millionaire, lunch watching someone display a luxury watch, and the evening watching a tour of a house worth 20 times his annual income. The brain receives the image but rarely receives the denominator. You do not know the person's debt, family money, income, or savings. You may not know whether the product was sponsored, rented, or borrowed. You do not even know whether the person displaying it owns it. None of that is necessary for comparison to occur. The signal has already been transmitted. The technology is new, the mechanism is not. The Gilded Age displayed wealth through mansions, servants, and leisure. The 20th century democratized visible consumption through mass production. Consumer finance allowed future income to purchase present goods, and digital media eventually removed the geographic boundary around comparison. Each stage made the status system more efficient. There is another important asymmetry. The person selling status gets paid regardless of whether the purchase strengthens the buyer's balance sheet. The automobile manufacturer receives revenue. The lender receives interest. The retailer receives its margin. The advertising platform receives money for attention. The luxury company receives its premium. The travel company receives payment. The social platform receives engagement. The household is the participant that must eventually reconcile the purchase with its future income. No conspiracy is required, only incentives. Businesses are rewarded for selling more. Lenders are rewarded for extending profitable credit within acceptable risk. Platforms are rewarded for holding attention. Consumers can receive social rewards for displaying certain purchases. Every participant can behave rationally according to its own incentives, while the combined system produces households with impressive incomes and surprisingly little retained capital. That is what systemic analysis reveals. The numbers show the difference between access to consumption and financial resilience. Federal Reserve data for 2024 showed that 81% of U.S. adults had a credit card. Among cardholders, 46% had carried a balance at least once during the previous 12 months. Middle-income adults were particularly likely to have cards and use them to finance purchases by carrying balances. At the same time, only 63% of adults said they could cover a hypothetical $400 emergency expense entirely using cash or its equivalent. Think about the structure behind those numbers. A modern economy can surround households with extraordinary visible abundance while a substantial share of adults remain vulnerable to a relatively modest, unexpected expense. There is no contradiction. The abundance can be real. The fragility can also be real. Access to consumption is not the same thing as ownership of capital. This becomes even clearer when income and wealth are separated. Income is a flow. Wealth is what remains. A household whose financial position includes home equity, retirement assets, business ownership, and low debt has a fundamentally different structure from a household displaying a similar lifestyle through financed vehicles and revolving credit. From the street, they can look identical. On a balance sheet, they are different economic organisms. Consider someone earning $200,000 annually. To a household earning $50,000, that income may appear enormous. But suppose the higher earner lives in an expensive neighborhood, finances luxury vehicles, travels frequently, and maintains a lifestyle calibrated to colleagues earning even more. The salary is high. The obligations are also high. Now imagine another household earning $100,000 with modest fixed expenses and substantial accumulated assets. Which household is richer? Visible consumption cannot answer that question. You need the balance sheets. And that is precisely what status culture obscures. It encourages people to estimate financial position through consumption rather than ownership. The trap becomes even more powerful because status purchases frequently create secondary costs. A more expensive vehicle can bring higher insurance, maintenance, and financing costs. A larger house can bring higher taxes, utilities, furnishing expenses, and maintenance. A prestigious neighborhood can also change the reference group surrounding the household. Suddenly, the old car feels inadequate relative to the driveway. The furniture feels inadequate relative to the house. Vacations are compared with neighbors and coworkers. One purchase changes the environment in which future purchases are judged. Yesterday's luxury gradually becomes tomorrow's baseline. This is where the mechanism becomes difficult to reverse. A household can sell an expensive vehicle, move into a smaller house, stop traveling, and reduce restaurant spending. Mathematically, these choices remain available. Socially, they are more difficult. Once consumption becomes connected to identity and position, reducing it can feel like public decline. Moving upward feels like progress. Moving downward feels like failure, even when moving downward would strengthen the balance sheet. That makes lifestyle inflation asymmetric. Status standards adapt upward more easily than they adapt downward. Once a household builds recurring obligations around peak income, future income becomes partially pre-spent. At that point, only a few mechanisms can preserve the structure. Income must continue rising, debt must increase, savings must fall, or the lifestyle must eventually contract. None can continue indefinitely. Income cannot rise forever at whatever rate consumption demands. Debt eventually encounters borrowing limits and interest costs. Savings cannot fall below zero forever. Eventually, the adjustment reaches consumption. That is the constraint. History repeatedly exposes this mechanism during periods of financial stress. Before the 1929 crash, American households had increasingly gained access to credit for automobiles and other durable goods. When economic conditions deteriorated, purchases of expensive goods fell sharply. Automobile demand weakened, factories reduced production, and unemployment increased. Another version appeared during the Great Recession. Automobile sales fell dramatically as the economy weakened and access to financing tightened. Credit matters because modern consumption is partly constructed from claims against future income. When credit contracts, the future cannot be pulled into the present as easily. Demand falls, invisible lifestyles are forced closer to underlying cash flow. That reveals something important about apparent prosperity. Some consumption is funded by current income. Some is funded by accumulated wealth. Some is funded by future income. From the outside, those sources look identical. A $70,000 car purchased with cash and a $70,000 car purchased with debt occupy the same parking space. The balance sheets behind them do not. That is why status is such an unreliable measure of wealth. It observes the asset while ignoring the liability. It sees the house, not the mortgage. It sees the purchase, not the opportunity cost. It sees the lifestyle, not the capital required to sustain it. There is an even deeper asymmetry. The person accumulating wealth quietly creates almost no public signal. There is nothing impressive to display about money that was not spent. Nobody sees the car you decided not to upgrade, the hotel you did not book, the additional room you decided you did not need, or the balance that remained untouched. Financial reserves have no logo. Low fixed expenses attract no attention. Unused borrowing capacity looks exactly like nothing. The social reward usually arrives when capital becomes visible consumption. So the incentives can become inverted. Behavior that strengthens a balance sheet is often invisible, while behavior that weakens it can be highly visible. This is why status competition does not disappear among intelligent or highly paid people. Knowledge alone does not remove the incentive. A physician understands debt. A lawyer understands compound interest. An executive understands cash flow. But each can still operate inside a professional environment with its own consumption standards. Income does not eliminate status competition. It changes which competition you enter. At one income level, the signal might be clothing or electronics. At another, it becomes vehicles, neighborhoods, private schools, watches, clubs, second homes, or travel. The objects change. The mechanism survives. This is how trying to look wealthy can prevent someone from accumulating wealth. Not because every expensive purchase is irrational, and not because consumption itself is a mistake. The mechanism is more precise. When visible consumption automatically rises with income, the surplus required to accumulate capital shrinks. When social comparison determines the consumption baseline, satisfaction becomes attached to a moving target. When credit allows consumption to move ahead of accumulated wealth, appearance becomes detached from financial reality. And when identity becomes attached to that appearance, reversing the process becomes increasingly difficult. That is the status trap. The person believes they are spending the rewards of becoming successful, while they may actually be spending the capital that could have made that success durable. History repeatedly returns to the same distinction. Income is a flow. Wealth is accumulated ownership. Status is a social signal. Credit is a claim on future income. Confusing those categories creates the illusion. A large income can produce a large status signal without producing substantial wealth. Credit can enlarge that signal beyond what current wealth would support. Social comparison then makes the enlarged signal feel normal. Once normal expands, the next increase in income is already spoken for. That is why the system does not require obviously reckless decisions. It works through individually reasonable ones. A slightly better car, a slightly larger home, a slightly more expensive vacation, and a slightly higher standard. Repeated often enough, a household can eventually discover that its income has risen dramatically while its financial freedom has barely moved. The irony is that genuine financial resilience often becomes less visible as it grows. A paid-off obligation produces no photograph. Emergency reserves create no social signal. Money that remains unspent attracts no admiration. But invisible financial capacity becomes extremely important when income disappears, businesses fail, markets decline, or unexpected expenses arrive. The status system measures what can be displayed. Financial resilience measures what remains when the display is removed. Those are different accounting systems. History suggests that societies repeatedly confuse them. Wealthy groups display consumption, others imitate the display. Industry manufactures the symbols at scale. Finance makes those symbols accessible before the underlying wealth exists. And media expands the comparison group. The standard rises. Households commit more future income to maintain it. The distinction between looking prosperous and being financially secure becomes harder to see until something interrupts the cash flow. A recession, a job loss, a credit contraction, or an unexpected expense. Then the balance sheet becomes visible, not publicly, privately. That is when a household discovers whether its lifestyle was supported by accumulated capital or uninterrupted access to future income. This is historical and educational analysis, not financial or investment advice. The status trap is not fundamentally about luxury. It is about confusing evidence of wealth with wealth itself. Veblen observed the mechanism in 1899. Mass production expanded it. Consumer credit accelerated it. Digital comparison globalized it. The products changed, but the underlying incentives remained remarkably familiar. Financial position cannot be reliably measured by what someone displays while income continues to arrive. The more important evidence is what remains after the display is removed. This channel exists to examine systems from that angle because financial structures are often easiest to understand when the visible layer is stripped away. Status symbols will continue changing. The mechanism underneath them is much older. And once you understand that mechanism, the question is no longer who looks wealthy. The question is, who actually owns the wealth behind what you can see?